Hello and welcome back to Money Mastermind. Today we are exploring how to become a teenage millionaire. Now let's get started. But first, if you enjoy this content or anything related to investing, be sure to like and subscribe for more videos like this. Now, let's get straight into it.
In today's financial world, the idea of teenage millionaires isn't just a fantasy but an actual reality. It highlights the importance of creating financial literacy from a young age, an essential skill set often overlooked in traditional education. The journey towards becoming a teenage millionaire begins with understanding the fundamentals of personal finance, investing, and wealth management. Financial literacy enables teenagers to make informed decisions about money, setting them on a trajectory towards financial independence and security. It equips them with the knowledge to navigate complex financial markets, seize opportunities, and mitigate risks effectively. It also instills invaluable habits of budgeting, saving, and investing early on, laying a solid foundation for long-term wealth accumulation. By grasping the concepts of compound interest and asset allocation, you can exploit the power of time to your advantage. Even modest contributions to investment accounts can snowball into substantial sums over the years, thanks to the magic of compounding. This emphasizes the transformative potential of smart investing and saving habits practiced consistently over time. The rise of teenage millionaires serves as proof to the transformative power of financial literacy and wise financial decision-making. It reinforces that age is no barrier to building significant wealth, provided you possess the knowledge, discipline, and determination to succeed. As we dive deeper into the strategies and techniques for teen wealth building, it becomes clear that the journey to financial freedom begins with a single step: the decision to begin the path of financial education. Beginning the journey of investment at a young age grants several advantages that can pave the way for a financially secure future. One of the most powerful forces at play is compound interest, a concept that magnifies the growth of investments over time. By initiating investments as a teen, you unlock the full potential of compound interest, allowing your money to work smarter and harder for you. To grasp the profound impact of compound interest, consider this scenario. Two individuals, one who begins investing at age 18 and another at age 30, both start with an initial investment of $10,000, a monthly contribution of $100, and an average return rate of 7%. If they both take their money out by the time they are 65, the 18-year-old will accumulate $635,000, while the 30-year-old only accumulates $272,000. The long-term benefits of early investments extend beyond monetary gains. By creating a habit of saving and investing from a young age, you develop invaluable financial discipline. You learn to prioritize long-term goals over short-term gratification, laying the groundwork for a lifetime of wise financial decision-making. Basically, the power of starting early lies not only in the accumulation of wealth, but also in the creation of financial resilience and independence. By exploiting the magic of compound interest and embracing the principles of delayed gratification, you can set yourself on a trajectory towards a prosperous and secure future. A strong financial foundation is fundamental of long-term financial success, making it essential for you to prioritize financial education and understanding basic financial concepts. By equipping yourself with the necessary knowledge and skills, you can lay a solid groundwork for your future financial endeavors. Financial education serves as a compass in navigating the complex world of personal finance. Understanding concepts such as budgeting, saving, investing, and debt management allows you to make informed decisions about your money. It enables you to develop sound financial habits early on, setting the stage for a lifetime of financial well-being. To build a strong financial foundation, you can use practical strategies such as budgeting, saving, and setting financial goals. Budgeting allows you to track your expenses, identify areas for saving, and allocate funds towards your priorities. Setting financial goals provides you with a sense of purpose and direction, motivating you to work towards tangible objectives such as saving for college, purchasing a car, or investing in your future. Parents, schools, and mentors play a crucial role in providing financial guidance to teenagers. Parents can lead by example, demonstrating responsible financial behaviors and encouraging open discussions about money within the family. Schools can integrate financial literacy education into their curriculum, equipping students with practical knowledge and skills to navigate real-world financial challenges. Mentors, whether they be family members, teachers, or financial advisors, can offer personalized guidance and support, helping you make informed decisions and stay on track towards your financial goals. In conclusion, building a strong financial foundation requires a combination of education, practical skills, and guidance from trusted sources. By prioritizing financial literacy, implementing sound financial practices, and leveraging the support of parents, schools, and mentors, you can set yourself on a path towards financial success and security. As you begin your journey towards financial independence, understanding investment strategies tailored to your needs and risk tolerance is crucial. Introducing a range of investment options suitable for you can grant you the opportunity to grow your wealth over time while mitigating risks. Stocks, index funds, and real estate investment trusts are three investment avenues well suited for teenagers seeking to build wealth. Stocks offer the potential for high returns, but come with higher levels of risk due to market volatility. Index funds, on the other hand, provide diversification by tracking a broad market index, reducing individual stock risk. Real estate investment trusts allow you to invest in real estate without the hassle of property management, offering steady dividends and potential capital appreciation. Each investment option comes with its own set of risks and rewards. Stocks offer the potential for significant capital gains, but are susceptible to market changes. Index funds provide diversification and long-term growth potential, but returns may be more modest compared to individual stock investment systems. REITs offer exposure to real estate markets and regular income streams, but may be influenced by economic conditions and interest rate changes. To make informed investment decisions, you should conduct thorough research and due diligence. You can start by learning about the fundamentals of each investment option, including how they work, their historical performance, and associated risks. Utilizing resources such as financial news websites, investment books, and online courses can deepen your understanding of investing principles. Building a diversified portfolio is essential for reducing risk and maximizing returns over the long term. You can achieve diversification by allocating your investments across different asset classes, industries, and geographic regions. This helps spread risk and minimizes the impact of any single investment's performance on the overall portfolio. In summary, being introduced at a young age to various investment options, explaining the risks and rewards, and providing tips on research and diversification allows you to make informed investment decisions and start a path towards financial success. To set out on your wealth-building journey, you can use these strategies and tailor them to your financial goals and aspirations. Here are some practical tips to guide you through the process. 1. Research and analysis. Start by researching different investment options, understanding their risks, rewards, and suitability for your goals and risk tolerance. Learn how to analyze financial statements and key financial metrics to assess the performance and health of potential investment. Use online resources, investment books, and reputable financial websites to deepen your understanding of investment principles and strategies. 2. Goal setting and planning. Set specific, achievable financial goals that align with your short-term and long-term aspirations, whether it's saving for college, a car, or retirement. Create a roadmap outlining the steps needed to achieve your financial goals, including saving targets, investment strategies, and timelines. 3. Discipline and patience. Stay disciplined with your savings and investment plan, committing to regular contributions even during market changes or economic downturns. Avoid impulsive decisions and maintain a long-term perspective, understanding that wealth building is a gradual process that requires patience and perseverance. 4. Resources and tools. Explore budgeting apps to track your expenses, set savings goals, and manage your finances effectively. Use investment calculators to estimate the potential growth of your investments over time and evaluate different scenarios. Take advantage of educational websites, online courses, and financial literacy programs to further your knowledge and skills in personal finance and investing. By using these practical tips and leveraging available resources and tools, you can take control of your finances, make informed investment decisions, and work towards building a prosperous and secure financial future. While on your investment journey, you may encounter various challenges and pitfalls that can derail your financial goals. It's crucial to identify these obstacles and equip yourself with strategies to overcome them, ensuring a smooth path towards wealth building and financial success. 1. Impatience. One common challenge for teens is the temptation to seek quick returns or instant gratification from your investments. To overcome impatience, focus on the long-term perspective and the power of compounding. Remind yourself that wealth building is a gradual process that requires patience and discipline. Set realistic expectations and understand that investment success takes time and consistent effort. 2. Lack of knowledge. Many teenagers may feel overwhelmed by the complexities of investing and lack the necessary knowledge and expertise. Combat this challenge by dedicating time to educate yourself about investing principles, strategies, and market dynamics. Take advantage of resources such as books, online courses, seminars, and mentorship programs to improve your understanding and confidence in investing. 3. Peer pressure. Peer pressure can lead you to make impulsive investment decisions or follow trends without thoroughly evaluating the risks. Stay true to your financial goals and investment strategy, regardless of what others may be doing. Surround yourself with supportive peers who share similar financial values and goals, and seek advice from trusted mentors or financial professionals. 4. Emotional investing. Emotional investing, driven by fear or greed, can lead to irrational decisions and undermine long-term investment success. Develop a disciplined investment approach based on research, analysis, and a well-defined strategy. Practice mindfulness and emotional detachment from short-term market changes, focusing instead on the fundamentals of your investments. By recognizing and addressing these challenges proactively, you can navigate the investment landscape with confidence and resilience. With patience, knowledge, discipline, and a steadfast commitment to your financial goals, you can overcome obstacles and pave the way towards a prosperous financial future. In conclusion, the journey to becoming a teenage millionaire is not merely a dream but a realistic possibility, achievable through strategic planning and informed decision-making. By starting early, you unlock the power of compound interest and lay the groundwork for long-term wealth accumulation. Building a strong financial foundation through education, budgeting, and goal setting allows you to navigate the complexities of personal finance with confidence. Key takeaways from this video include the importance of starting early. Initiating investment endeavors at a young age maximizes the benefits of compound interest and sets the stage for financial success. Building a strong financial foundation. Understanding basic financial concepts, practicing wise money management, and setting clear financial goals are essential components of a solid financial framework. Making informed investment decisions. Conducting thorough research, analyzing investment options, and staying disciplined in the face of challenges are crucial for achieving long-term investment success. We encourage you to begin your wealth-building journey now by implementing the strategies and tips discussed in this video. Remember, the earlier you start, the greater your potential for wealth accumulation. Also, continue your financial education journey by exploring resources such as books, online courses, and financial advisory services. With dedication, perseverance, and a commitment to financial literacy, you can take control of your financial future and work towards achieving your dreams.
Thanks for watching Money Mastermind. If you enjoyed this video, be sure to check out our other videos for more investing tips. Don't forget to like and subscribe to stay updated on all our latest videos, and we'll see you in the next one.